Hey guys, it's Hakeem here and welcome back to another stock analysis video. And today we are going to be talking about the world's largest semiconductor chip manufacturer, and that is Intel. Now, Intel is a hot topic at the moment with a lot of people either on the fence of Intel being the better buy and the others being on the fence of AMD being the better buy. So today we're going to run through the historical financial results of Intel. We're going to look at the future prospects for the business, including some possible headwinds, and then we're going to look at the valuation to see if it all ties up. Now, in terms of the historical financial review, I like to look for 6 key metrics that I believe are hallmarks of a financially sound business. And these are revenue growth, earnings growth being EBITDA and net income growth, free cash flow growth, a return on invested capital which is greater than 10%, an interest cover of at least 2, and then shares outstanding which are stable but preferably declining over time. So we're going to analyse each of these in turn for Intel to see if this is a business with strong fundamentals with a history of performing well. So the first thing that I want to draw your attention to is the historical stock chart, and I think that this is really interesting, particularly given the times that we are in today. So in 2000, at the peak of the dot-com bubble, Intel was trading at $70 a share. If you would have bought shares in Intel at that point, over 20 years later, you would be 27% down on the stock. Now, this just goes to show you that valuation matters, right? You cannot just buy any stock just because it's growing and expect to make money. And I thought it'd be interesting to show you the 2000 annual report for Intel. And we can see that revenues were at $33.7 billion. Now, today revenues are at over $75 billion or around $75 billion, right? So revenues have doubled, but the stock price has fallen by 27% in that time. So the sort of point number one is that valuation matters. Do not overpay for a stock. So metric number one is revenue growth, and revenues went from $59 billion up to $78 billion in 2020, showing a compounded annual growth rate of around 4%. So it isn't fantastic growth, but it is growing nonetheless, and it's still a check mark against that metric. So because the business is growing at a lower rate, we are going to want to pay lower multiples for that business, and we'll come on to that in the valuation. Now, metric number 2 is earnings growth. So we can see here that EBITDA went from $23 billion in 2016 right the way up to $36 billion in 2020. So that's fantastic growth, and it's actually growing at a quicker rate than revenues, which shows margin expansion. So that's definitely a tick. Net income went from $10 billion in 2016 up to $21 billion in 2020. So their income has doubled despite the fact that their revenues have only increased by 4% year over year. So that is fantastic and definitely a tick against that check mark. Similarly, with free cash flow, we've gone from $2.60 per share in 2016 up to $5 per share in 2020. So free cash flow has almost doubled as well, which shows that free cash flows are growing at a greater pace than revenues. Again, that is good to see. Metric number 4 is return on invested capital being greater than 10%, and it will come as no surprise that Intel has passed this metric as well, sitting at 16% in 2016 up to 19.5% in 2020. So a definite check mark there as well. Now, metric number 5 is more of a measure of a company's financial health. So this is a way for us to see whether the company is going to be under any distress if there is a downturn in the market, right? So we look for an interest cover which is greater than 2. In other words, their profits have to be twice as high as their interest expenses in order to pass this metric. And that is an absolute minimum. So we can see here for Intel, their interest cover was 20 in 2016, and that has risen to 38 in 2020. So that's fantastic. So at the moment, their profits are 38 times greater than any interest expenses that they have to pay. So clearly there's no worry about them defaulting on any of their debt repayments. Metric number 6 is shares outstanding. Now, if we see this decreasing over time, it means that the company is buying back shares and therefore increasing the existing shareholders' percentage of ownership in the business. So that is good to see. We can see here that in 2016, shares outstanding were 4.7 million. And in 2020, they were 4 million. So that is a massive increase in the buyback of their shares, which is definitely good to see and a check against that check mark. So despite all of the rhetoric that is out there that Intel is a dying business, we're seeing increasing revenues, increasing profits, increasing cash flows. We're seeing shares outstanding reducing. And on a historical basis, the business looks pretty good. What are the prospects for the business going forward? Because it's all good and well looking at the historical return of a business, but ultimately markets are forward-looking mechanisms. And therefore, if the outlook for the business is not good, you're not going to see a good return on your investment. So let's have a look at the tailwinds and headwinds for this business. Now, I want to start with the most obvious headwind for Intel, and that is that their quality and performance of their chips are falling behind their competitors, such as AMD. And as a result of that, they are losing market share. And this isn't sort of scare tactics, this is actually playing out, right? So we can see here that Intel's market share back in 2016 was sitting at around 82%. And at the end of 2021, their market share is now only 61%. So they are still the market leader, but you can see that AMD has made up significant ground. There's no doubt about that. And we've seen that in the growth rates of AMD's figures. If you look to their financials, their revenues and their earnings have grown significantly. So does this mean that Intel's business is dying and therefore you shouldn't even consider this as an investment? Well, no, of course not. It just means that you have to take it into consideration when you're forecasting for the business going forward. It wouldn't be the first time that AMD have actually caught up with Intel in terms of market share. So we can see here that in 2016, AMD actually got to 48% market share and then they declined since. So it's quite likely that this will change over time, and who knows what the market share will be 10 years from now. One thing that we can be certain about though is that the global demand for semiconductors is continually increasing, and therefore even if Intel aren't able to increase their market share, because the market itself is continuously expanding, then Intel will see growth as a result. So we can actually see here that the market is projected to grow from $452 billion in 2021 to $803 billion in 2028 at a compounded annual growth rate of 8.6% in the next 7 years. And that is some significant growth. So that in itself suggests that even if Intel's market share remains completely stable, and that is despite all of the reinvestments into the business that they are making, which we'll get onto in a moment, and that they don't increase their prices, which, let's be honest, is unrealistic considering increased demand means increased prices, that their revenues would grow by 8.6% per year for the next 7 years. So then that segues quite nicely onto growth prospect number 2, and that's all to do with the reinvestment that Intel are making into the business. So we can see here that Intel is in a period of massive capital expenditure as it spends $20 billion this year, including on a new semiconductor factory in Arizona. Now, a lot of companies don't even make $20 billion in revenue, never mind profits or free cash flow, to be able to do these kind of investments. And this is all in a bid by the company to shift its business model to become a manufacturer or a foundry for other chip designers, in addition to continuing to design and manufacture its own processors. Now, this is a process that Intel have said in the short term will definitely hurt its margins, but in the long term, it will be very lucrative. And this ridiculous level of reinvestment into the business is expected to continue for the next few years, as management are expecting to spend between $25 and $28 billion in 2022, with the potential for further growth in subsequent years. So clearly this is a big move by management to try and turn around the business, and management are actually expecting between 10 and 12% CAGR over the next 4 to 5 years, which is substantially larger than the CAGR that they've achieved over the 5 years prior. So then that brings us on to my discounted cash flow and earnings multiple model to try and determine what the fair value of the business is. So you can see that for 2 to 5 year revenue growth, I've gone with 8%. And for revenue in 2022, I've gone with $74 billion, which is it's effectively flat, right? And that is what management has told us they're expecting for 2022. Now, you may notice that for 2021, it looks like revenues have actually declined by 5%. Now, that isn't actually the case. It's just that these figures here exclude the revenues earned from their NAND business, which is now discontinued. And therefore, it wouldn't be right to continue those revenues on going forward, and therefore we've excluded them there. So actually there hasn't been that decline. When you include that NAND business, revenues were flat year over year. Anyway, moving on to 6 to 10 year revenue growth, I've gone with 4%. So I think that growth rate of 8% and then a growth rate of 4% is pretty conservative, considering this is well below management's expectations. However, just to be clear, I have included within my free cash flow the significant increase in the capital expenditures required in order to drive that revenue growth. And that's because it wouldn't be fair to take the benefit of the revenue growth without incorporating into the fact that free cash flows are going to reduce by making these investments. So you can see that free cash flow actually reduces down, according to my model, to $4.5 billion and then $7 billion in 2022 and 2023 respectively. I've calculated a weighted average cost of capital of 8.3% for the business, and we've got a net debt, which is the difference between these two figures, of $5 billion. And then using a terminal growth rate of just 1.5%, we can see that the intrinsic value per share, according to the discounted cash flow model, is $68 a share. And then similarly for the multiple of earnings, I've used a PE ratio of 12 in 10 years time, which I think is probably fair. We get an intrinsic value of just $42 per share when that is discounted back to today's value. When we take the average of each of those, we get an intrinsic value per share of around $55, which would mean a margin of safety at today's price of around $51 of 8%. Now, personally, I think that Intel gets really interesting at the $45 range, because if you do that, you see a margin of safety of around 24% if you believe in the inputs that we've gone through today. Now, if we apply a slightly different approach and we go for a 2025 price target for the business by applying an enterprise value to EBITDA multiple at that time, we can see that if we apply a multiple of 7.5, which is by and large in range with its historical average, we get a 2025 price target of $86 after you take into consideration the fact that they are buying back their shares. That'd be a compounded annual growth rate of 11.7%. When you throw in the mix the 2.7% dividend yield, that's a total return of 14.4%, so definitely not too shabby. Clearly, all of this depends on the success story of Pat Gelsinger's and the rest of Intel's management's turnaround story. However, considering that I've been relatively conservative with my assumptions here, it's quite possible that there could be further upside. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.